I'm Melissa Bijak. I am a partner in our business valuation and litigation support group. I will be speaking along with my senior manager, Brad Matthews. And today we're going to be talking about analyzing financial statements from a valuation perspective. So I think, when you flip slides, sorry. So when you think about it in your businesses, most decisions that are made by management of the company, or even, part of our practice is in litigation support. And so in those venues that are subject to legal controversy, or they will involve and certainly be resolved through economics associated either with a transaction or with a case. So oftentimes we're working with management of the company, looking at making certain decisions to invest in a large piece of equipment, to decisions to invest in a business line, a company. All of those things are going to require analyzing, financial statements of the company or the target. So the economics really of any particular fact pattern that we're involved in are generally going to be built around the foundation of the financial information as set forth in the company's financial statements. Understanding that we work with clients that have financial statements that are produced through QuickBooks. We have clients that have compiled, audited, and reviewed financial statements. So, but typically those financial statements that we're working on with the clients we're going to talk to you about today have a full set of financials, balance sheet, income statement, cash flow, notes to the financials. So we're going to kind of keep in that, a little bit in that zone as we walk through some examples and give you some insight today. So today we're going to look to go beyond the numbers that you see on the financial statements. And I know most of you in the room are probably very good at analyzing your financial statements, whether you're a financial officer or you're involved in project management. Understanding the numbers and certainly looking beyond those numbers are very important. But what we look to do today is to provide a high-level view that how valuation professionals assess and analyze a company's financial statements. So we plan on covering financial statement analysis. We'll talk a little bit about financial ratios, mostly from a high level. And then we'll talk about how valuators assess specific company risks, those risks that are inherent to the specific company at issue. And then Brad's going to wrap things up talking about, with all of this analysis, how does that impact the determination of value of any operating business? So, and feel free, if you have questions, you can stop us as we go along, or you can withhold your questions till after and during the break. But when we talk about financial statement analysis, obviously the primary objective to the financial statements is to obviously assist any decision maker in many purposes. So it can be just management reviewing the financial statements on a monthly, quarterly, annual basis in order to make decisions on performance of the company. It can be making any type of decision regarding transaction, anything like that. But financial statements are really there to assist in decision-making process. What we always focus on is the full set of financial statements, including footnote disclosures. Financial users should not only consider the stated amount of assets, liabilities, and earnings, but certainly looking to the underlying detail of those balances to really understand the embedded strengths, the quality of those figures, and certainly the risks associated with those figures that are recorded on the financial statements. So next, talk a little bit about assets on the financial statements. We are very much, as a valuation team, concerned with, first and foremost, what are the assets that are recorded on the financial statements? Understanding what is their stated value? Is it in accordance with GAAP? Is it on a fair value, a fair market value basis? And we want to look at the associated risk with every asset. Obviously, investors in your company, lenders, when you're working with them, are only interested in how readily your company's assets can convert to cash. So you have a significant balance of receivables on your balance sheet. We're going to be very curious as to the aging of those receivables. We're going to be very concerned with any receivables that are at risk where we have an allowance. So definitely looking to how quickly any of the assets that we have on the balance sheet can convert to cash. Obviously, as we get down through the balance sheet, those assets certainly have a lesser time or a longer period of time to convert to cash, if at all. One thing and most of you probably know this, unless you purchased a company and you have recorded intangible assets in accordance with purchase price accounting, you're not going to have any intangible assets recorded on the balance sheet. However, most operating businesses that are producing sufficient cash flow in excess of a return on their tangible assets, their hard assets, certainly have intangible value. And that intangible value can be in anything. It could be in your customers, contracts that you have. It can be a patent. It can be just the name recognition. Any of those things contribute, and just general goodwill contributes to the overall intangible value of a company. But when we get in there for valuation purposes, we know right off that our job is let's quantify what that intangible asset value is that's not recorded. Moving on to liabilities. When we assess liabilities, we're going to consider a couple attributes. Certainly the value of the outstanding debt obligations, and then timing of payments. When does that hit cash flow? A company's financial strength generally improves, obviously, to the extent that it can defer liabilities into future dates. And if you look at the top of the liabilities on the balance sheet, to the extent that a company can push out their payables, to the extent possible, frees up a little bit more working capital. And obviously, when you talk about long-term assets, when you can push those amounts out into the future, certainly less strain on cash flow. Greater reliance is going to be placed on those liabilities that are fixed in nature versus one that's subject to an estimate. So when you look back in the financials and you realize that the liability needs to be recorded, however, it's an estimate, we're going to dig deeper into something like that to determine whether or not that estimate is really the true economics of the transaction or the situation. And then lastly, and most importantly, when you talk about the balance sheet specific to liabilities, any user of the financials should consider whether or not there are any unrecorded liabilities that might impact the financial analysis of the company. So anything that is not even disclosed in the financial statements, maybe not even a subsequent event, there may be some off-balance sheet liability that we'll need to understand. There might be pending or even threatened litigation that we want to be knowledgeable of and take that into account. Next, moving on to the income statement, obviously looking at the quality of earnings. If you've purchased a company or if you're doing sell-side due diligence, you're going to be looking at the quality of your earnings or a quality of earnings of the company that you're looking to purchase. So what we're doing is we're analyzing the income statement by detail and certainly looking at key components of income. We'll be starting at top line. We'll move to gross profit and then operating profit and certainly EBITDA. Certain adjustments will be made, obviously, and I'll talk about that in a minute. But, we've always talked about, even, Bob, when you and I were on the stage, we talked about, when you value companies, you might have two $10 million companies, and people want to, well, let's just apply a revenue multiple to determine the value of the business. Well, that's not always the way to go, because I might be operating a $10 million company, and for lack of better business acumen, my operating margin is 2%. Bob might be operating his company at top efficiency, and he has 15% margins. So at the end of the day, even though we have the same revenue, obviously Bob's company is going to be worth more than mine. So those are the things that we're going to be looking at from a valuation perspective. But first and foremost, you're going to remove any anomalies, any one-time items, extraordinary items. Maybe you've had a strike, you had a fire, you had a one-time significant bad debt that needs to be removed from consideration. Why? Because that's not reflective of the operations or the earnings of the business on an ongoing basis. Impact of non-operating items of expense or income, PPP. You're obviously not going to be receiving that every year. That, the income associated with that needs to be removed. Any other non-operating items of income and expense will certainly be removed because what we're trying to isolate here is on a normalized basis, what is the cash flow or the earnings that the business is throwing off. And then lastly, we'll look at the impact of GAAP accounting versus economic reality. We understand that my colleagues here are they're held to produce financial statements in accordance with GAAP. Well, there are times where we're doing the valuation and we diverge from GAAP and move into more of an economic reality of the earnings and cash flow of the business. Most importantly, we look at comparability. It's going to be very difficult unless it's blatant like PPP to understand if the company has an anomaly. So what you want to do is you want to look at comparability. You want to have 3, 4, 5 years. I like to look at a business cycle of earnings, and you're going to want to look to see, okay, where have there been fluctuations? Can that be explained? And those are the areas where we're going to be looking at making certain normalization adjustments to arrive at what we feel is that normalized level of income and cash flow. And then circumstances that may impact comparability that could be fairly benign. Reclassifications. We may have seen a higher gross profit in the past, and in the next year gross profit is a little bit lower, but we see operating profit maybe staying stable. All that was a reclass from something in operating expenses up to cost of sales. New or discontinued operations. Discontinued operations will be certainly marked on the financial statements below the line, but there might be a new line of business that would obviously affect comparability. And then unusual or infrequent transactions. An isolated transaction, maybe the significant repair of a piece of equipment that isn't expected to recur. Things like that. Any questions on that before Brad takes over with ratios? All right, big guy.
And so when we talk about analyzing financial statements from a valuation perspective, I always like to point out the fact that what we're doing is, from a valuation perspective, is not dissimilar from buy-side diligence. We are trying to look at a company the same way that a buyer is going to look at a company, because our goal is to determine what is the price that a buyer would pay for that business. That's the end game here. What is that number that a buyer is willing to pay? So when we look at financial ratios, although it may seem a little bit more academic, understand these are tools that buyers, that valuators are going to use to understand the financial statements, interpret the financial statements, and understand specifically any strengths or weaknesses that they can glean from the business as a result of these financial ratio analyses. So kind of preface any of these analyses with saying, any ratio by itself is kind of meaningless, right? I mean, a static ratio can tell you something, but you really glean more information when you start taking that ratio and saying, all right, well, how does this compare to competition? How does this compare to how the business did last year? And how does that tell the story of what's going on with the business as of the date that we're looking at it, as of today? So looking at it in a vacuum can provide some insight, but it's truly more meaningful when you start being able to say, how does this tell the story of where the business has been, where we expect it to go in the future, and how more or less risky it is compared to other investments, other companies similar to itself. The selection of any of these ratios, none of these will be, one size fits all. It's always going to be dependent on what is the type of business that we're looking at? Is it a service business? Is it a manufacturing business? What is the overall economic climate that we're looking at? All these things are going to impact the types of analyses that you're going to want to run, the types of ratios that make sense whenever you're trying to analyze a business, again, from the perspective of a potential buyer or valuation professional. So when we look at financial ratios, there's 4 basic classifications. So coverage ratios are going to tell you how well a business can satisfy certain obligations. Return and turnover ratios each measure the benefit that a business generates based upon the specific resource that is being employed. One is going to be net, one is going to be gross benefit that we're measuring. And then a component percentage is just going to compare one component of a financial statement to another component of a financial statement and understand how those trends shift over time or how they may shift over time. We're going to discuss each of the 4 types of ratios: liquidity, activity, leverage, and profitability. So when we talk about liquidity ratios, obviously a measure of short-term solvency. So from a valuation perspective, it's going to measure how liquid is this business. And from a hypothetical buyer, what that tells me is how quickly can I convert these assets into cash? How quickly, more importantly, can I provide a return on my investment? So the more liquid a business, the more favorable it is whenever you're doing these types of measurements. So a few common ones that you're going to see: current ratio is going to compare current assets to current liabilities. How readily are we going to be able to compare, or how readily are we going to be able to satisfy those very short-term debt requirements as they become due? Quick ratio, even more specific, it's going to look at just your most liquid assets, so cash, receivables. How do those compare to the short-term obligations? And what comfort does that give me as an investor that as those short-term obligations become due, we're not going to have any problem in satisfying those? Working capital is obviously something that you're all very familiar with. You know, where are my current assets compared to my current liabilities at any given time? And I will say the management of working capital and understanding that management of working capital and the requirements that a business has is really a big deal in valuation. It's something that we look at anytime we're analyzing a business, specifically because to the extent that a business has low working capital requirements, it's pretty liquid. What that tells you as an investor is I can more quickly convert that GAAP income, that EBITDA, that net income, whatever it is, I can convert that more quickly to true cash flow, money that I can put in my pocket, than a business that has high working capital requirements. So the cash is going to be tied up on the balance sheet and other assets, receivables, what have you, in a shorter period of time versus if you're looking at a company that has significant working capital requirements where you're going to have that cash tied up in other places. Activity ratios are going to measure how effectively we use our assets. So it's going to compare, generally, results on the P&L to what our balance sheet looks like to tell us, as we employ these assets, how well are we doing and how well does that allow us to provide a return on those investments. So the greater the turnover, the more effective a company is in producing that benefit. So the two simple ones that we generally look at: AR turnover, the more readily you're turning over your AR, the more readily that AR is converting into cash. Inventory turnover is going to measure how quickly, how often inventory is created, sold, and again turned back into cash. I like to stop and point out here, this is one of those situations where it's going to be very industry specific, right? So if you have an industry that may be a niche manufacturer, their inventory turnover may be very different from another type of manufacturer that, you know, creates and sells inventory very, very quickly. So while these measurements at any point in time are important, it's also good to understand what would you expect given the environment that they participate in. Two others that aren't on here.
Brad, that actually causes me to mention, we had a client, and it's an annual ESOP client. So we had a client that pre-COVID had very slow inventory turns. They had a very high inventory balance, and we kept talking about, well, the economic reality, what's obsolete or what's just sitting there. Nothing is obsolete or sitting here. We just felt like we wanted to start having a more robust inventory because the business was growing, but they realized they had excess. So obviously when you have excess inventory, excess working capital, we add that back to the value of the business. And wouldn't you know, not that they knew it, but when COVID came along and now as we're moving forward, they're very glad that they stocked up on inventory. So now, that inventory that we thought was going to be sitting on the sidelines is actually being used. So
yeah, it's a good example of how measurement of these also needs to be framed by the current economic environment, the current industry environment. A couple that aren't on the slide that we also look at, total asset and fixed asset turnover. So comparing the total assets of a business to the sales levels, again, is important in measuring on a year-to-year basis to understand how the business is doing. But more importantly, if I compare business A to business B, Bob's business to Melissa's business, and one of them has a ratio that is much stronger than the other, as an investor, as a valuation professional, that's going to give me some sense of how more or less risky one business may be to another, just based on the fact that one may be more efficiently being able to use those assets to generate sales and earnings. Leverage ratios are going to focus on debt and the amount of debt on the balance sheet. So whenever we're looking at valuation, we're looking from that perspective of a hypothetical equity investor. And so while debt can lower the cost of capital, what it does is higher debt on the balance sheet, all other things being equal, is going to be a little bit higher risk to an equity investor because they are lower in terms of the residual return that debt holder now is in front of them in terms of who gets satisfied by the operations of the business. Leverage ratios, coverage ratios, just measure the ability, the company's ability to satisfy those obligations through operations. Debt ratios and debt to equity ratios can tell you how a business has historically funded operations, what level of debt versus what level of equity is used to fund those ongoing operations. Debt, again, overall, can lower what we call that weighted average cost of capital because the cost of debt is significantly lower than the cost of equity. That's a good thing. However, it does increase risk to that equity position, that end of the day common stock shareholder position that we're taking a look at.
The only other thing I would add here, Brad, is that we have rather large population of clients that have very little to no debt on the balance sheet. And as Brad said, when you have a healthy amount of debt, it lowers your cost of capital. But when you're looking at a transaction, especially a stock transaction, and stepping into the shoes of the prior owners, what that does actually is it enhances value because there's debt capacity. So you realize that stepping right into it, you have the ability to lower your cost of capital right off the bat because you can lever it up a little bit.
All right, so profitability ratios are probably the most common to the folks in the room here. We're going to look at margins, we're going to look at returns, gross margin, operating profit margin, EBITDA margin. And again, looking at these ratios in a vacuum or against historical performance of any individual company does tell the tale of what is going on with that company. But more importantly, when we're trying to analyze the risk associated with how strong or weak the margins are, we want to be able to compare this company's A margins to company's B margins, and we'll tell an investor, well, if I know that company A has margins significantly higher than company B's, as an investor, I'm more likely to get a return on my investment quicker than I would had the margins been smaller. So comparison to industry or competitors really illustrates that financial strength whenever looking at profitability ratios. A few other financial metrics. This one you may or may not have seen before. It's called a Z-score. It's actually an interesting metric that blends a number of different ratios together, 5 of them together. And it was originally put together to try and understand how close a company may be to file for bankruptcy. So what they do is they take a look at these ratios, and I wrote them down: working capital to total assets, sales to total assets, retained earnings, equity to liability, EBIT to total assets, and it measures the relationship between all of them. And what these studies have done in the past is they look at companies that are either filed for bankruptcy or close to filing for bankruptcy, and they try and understand what their Z-score, the combination of these 5, what that looks like compared to a much more healthy company. And what it does is it's an indication of overall financial health. It's not in any way supposed to be a predictor, but it is a way to take a look at understanding whether or not there are higher risks associated with an investment in that company. And then in general, growth rates. So valuation is always forward-looking. So we're going to be buying a company as of a specific point in time. We're going to be valuing a company as of a specific point in time. And what we're buying is the expectation of what that company is doing tomorrow, not what it did yesterday. But growth rates are important to understand because to the extent that I can take a look at the last 5 years or the business cycle of the company and use that to get comfort with what I believe the business is going to do tomorrow, those growth rates can be very telling in terms of forecasting what we believe our economic benefit will be after buying the company. And then kind of wrapping up this section, some common mistakes, misuses of these applications. Failure to use averages or weighted average can distort these ratios. Failure to recognize differences in accounting methods or specific factors affecting comparability. So Melissa touched on this, and it's even more evident in the last handful of years that we've seen. So very specific one-time instances that we hope will never need to be used again. Things like PPP income sitting on an income statement of a business or ERC income. You want to make sure that if a ratio that you're calculating is based on net income, and in 2021 there was this giant amount of net income that was skewed because the company was able to receive an employee retention credit or PPP, that's obviously going to affect comparability. And at the end of the day, you want to make sure that the comparability that you have is looking forward in terms of what you would hope to expect going forward.
So all of the analysis that we do kind of culminates and leads up to our assessment of what we call company-specific risk or unsystematic risk. And when I say unsystematic risk, that is the risk that a company has that's specific to the company. It's not shared with a broad market or the industry. And 4 areas of primary risks: size. Smaller you are, maybe the less resilient. Small companies may have had issues, certainly during COVID, may have gone out of business. Larger companies that have access to more capital and resources, typically fare a lot better. However, sometimes when a company is too large, certainly not as nimble, and maybe suffer actually more so. Macro environment. This is the risk that is to have a potential major financial impact on the company. When I talk about macro environment, that could be inflation. Certainly that's a topic. Employment or unemployment. Looking at how those macro events in the environment will impact the specific company. Industry. There may be things that are going on broadly in our company's industry, but really, how does that translate to the particular company that we're looking at? And then certainly company-specific attributes. And the next slide, when I talk about company-specific attributes, we look to a number of things, and this slide just has a few of them that are kind of the big ticket items. So dependence on a key person. One of the things that we look at, right out of the gate, who's running the company? And if it's one woman who has been involved with the business for 25 years, and there's a big gap between her and her mid-level management, that's reliance on a key person. The person, if Brad has all of the relationships with our customers, and that hasn't been transferred, or a plan hasn't been effectuated to transfer those relationships to someone other than Brad, that's an area of risk. Certainly, and what people are seeing now, companies are seeing now, they may not have seen in the past, but dependence on a key supplier. If you had a supplier relationship that, always Johnny on the spot, getting you the supplies when you need it, and yet you had dependence on one or two, during recent times, that may not have been good. It might actually be crippling on the company. Another big one is concentration of customer base. It's so big that they actually disclose that in a footnote in the financial statements. So if we have 2-3 customers that have 30, 40, 50% of our annual revenue, and those customers really aren't locked in to a long-term contract, we assess risk based on those factors. Financial forecasts or projections that are biased high. So if we receive forecasts that are more goal-oriented or strategic, Those are situations where if those forecasts or projections aren't going to be adjusted, we actually will increase the risk associated with achieving those forecasts or projections. Because as Brad said, we do look at the history of the company, but we only look at it such that we are looking for a proxy of the future. We only care about the business when we own it or operating it. So looking to those future forecasts are very important. Abnormal present or pending competition. What does competition look like now? But what is competition going to look like in the future? What if you have a situation where you're involved in an industry where there's a lot of consolidation? How does that impact companies? Sometimes it's positively, sometimes it's negatively. Pending lawsuits, very big. Sometimes you'll see something being accrued in the financials regarding a lawsuit, most of the time not. So we'll be asking questions on threatened or pending lawsuits. And then any pending regulatory changes. If your company is in an industry that's heavily regulated, if something is on the horizon, certainly we want to make sure that we're compensating for that risk, either in the discount rate that we're building up, the risk associated with the value of the company, or in the cash flow itself. So challenges for privately held companies is you certainly have less information than private companies or public companies because you don't have analysts following your businesses. And obviously that's what we're called in to do. So in our instance, quantifying that risk that's associated with the overall business can be very challenging. What we look to do in determining that risk in a systematic or formulaic way is we try to compare our specific company to guideline companies or really any other industry data that we can grab that will give us risk rates that might be relative to our specific company. And then at that point, we're going to identify those or try to identify those factors or circumstances that may require adjustment from a guideline company risk rate. And every time out, obviously, we're going to be thoughtfully and trying to not only quantitatively but qualitatively supporting our conclusions. So I think kind of final thoughts to put a bow on this, because I really am excited for Brad to talk about how this all comes together in valuation. But valuation or valuators will determine what are those specific risks that impact the company. Obviously, a company that's relatively more risky is going to have a higher rate and thus a lower value. Obviously, we're going to be any engagement that we take on, we're going to be summarizing those conclusions, organizing those thoughts to convey to our clients and what our view is as a hypothetical outside buyer of the company, what our view is of their risk profile.
So kind of bringing this to how does this analysis, how does looking at a company this way, how does it mechanically impact value? Obviously, we run these calculations. Somewhere it needs to be included in those calculations. So value is always going to be rooted in a risk-reward trade-off. Or said another way, the price of any investment must compensate that investor for the risk that they're taking for investing in that business or that asset, whatever it may be. So when we look at how investors are compensated, we're going to look at all the different stakeholders in the business. So, customers, employees, vendors, suppliers, they all trade value for goods or services. Your employees are trading their services for fair pay. The customers are obviously trading value for your goods or services, vendors doing it in the opposite situation. Lenders are going to be rewarded for providing financing to the business. So both in that interest expense that you're going to be paying them, but then also finding themselves ahead of equity holders in terms of priority for where they will be provided their return on investment. The government is always an interesting one that we like to point out. So the government's going to be a stakeholder in a business. And why is that? It's because they're going to take a portion of a company's net earnings, whether it's going to be directly through income taxes on a C corporation, or whether it's going to be their portion of a shareholder's pass-through earnings. A government is going to be a stakeholder in a business no matter what. sidebar, because Dawn's not here, if you were an IRS agent sitting in a CPA class and the tax partner asked you to raise your hand, would you really raise your hand, or would you just let them think that there are no IRS agents here? So, but
I raised my hand just to mess with them.
So knowing that after all of these stakeholders are satisfied, it is the common equity holders who are the residual beneficiaries of any business. So understanding that all of these stakeholders need to be accommodated first, we can now quantify what is that benefit that is actually falls through all of that after we've paid our employees, after we've bought our materials, after we've settled with Uncle Sam. What falls to the bottom line is the true return on investment for a stakeholder. So when all of those, or common equity holder, when all of those other stakeholders are optimized, that remaining what we call free cash flow, again, net of all of those things, is what is able to provide a return on investment for an equity holder. So as we discussed, the ratios and analysis are used to quantify that risk associated with the various operational and financial aspects of the business. So as we get into the different ways to value business, again, it's going to be based on what is the risk and what is the reward. The reward is going to be that free cash flow. What can I receive from this business after paying all of my stakeholders? And then what is the risk associated with that? That's what the ratios, that analysis helps us try and determine, is how risky this business is. So it's important to understand the mechanics of these calculations so that you can see how all of those numbers numerically, or how all of this numerically comes into play. So we're going to touch on the three foundational valuation approaches. Whether it's business valuation, real estate appraisal, whatever, there's three approaches to do it, no matter what. There's going to be an income approach, a market approach, and a cost asset approach. Income approach is going to be measuring the expected earnings of the business and trying to also quantify what is the required rate of a return that an investor would need to invest in it. A market approach, also going to look at the expected returns of a business, but going to look to market indications as to what multiple would an investor be willing to pay. So also looking at the rate of return, but just in a different form. It's a market multiple rather than a risk rate. And then the cost asset approach is going to be focused on the balance sheet. Very simplistic equation that we all know. Equity is assets minus liability. If I know the market value of my assets, if I know the market value of my liabilities, I'll know the market value of my equity. So starting off with the income approach, the first of the three, we have two different methods under this approach. The theory is exactly the same. There's really only three inputs to the income approach. Between the two different methods here, one of them is a little bit more abridged. It keeps one of those three assumptions consistent. We assume that most people know what a discounted future cash flow method is. In a capitalized cash flow method, exact same calculation, but instead of growth being multi-period across the go-forward look-out period that we're using, we're going to assume growth is linear. We're not going to assume abnormal growth during that period. So in order to kind of simplify the example, we're going to use that capitalized cash flow method as an abridged, simplified method to the income approach. But no, the two of these are the exact same calculation. It's just the fact that one assumption is kept consistent in the simplified model. So in our model, there's really, again, three things that we're looking at. It's going to be a numerator, which is the expected cash flow, that residual amount of earnings that fall through to the equity investor. What is the associated risk or rate of return that an investor is going to require for investing in that business? And then how are we going to incorporate expected future growth in there? Is it going to be in the numerator, or are we going to have varying level of expected growth in the future? Or are we going to incorporate it into the denominator where we can assume it's going to be linear over a period of time? So in our simplified equation, the numerator, and a bunch of accountants, let's put some numbers in front of them. The numerator we're going to say is $10,000 per year. All right, that's our expected economic benefit of owning any asset. Our risk rate that we've quantified, our rate of return, investor is going to require a 23% rate of return on an annual basis. And we expect that the long-term growth rate is 3%. So in a very simplified equation, the denominator here is going to be that risk rate, 23%, minus the growth rate, 3%. Our numerator is going to be the 10,000. We divide the 10,000 by 20% to get our indicated value, $50,000. We always say when we're on different webinars with other valuation professionals, at the end of the day, our job is not incredibly complicated. The mathematics and everything are pretty simple. My response to that is always, don't tell my boss that. So whenever we're looking at this method, the intent is to evaluate the credibility of each one of these inputs. So that's where the devil is in the details. That's where the job does get more complicated than that. Where are the risks of the business incorporated? So again, 3 things that we're looking at: cash flow, discount rate, growth. Risks of the business that we've identified are going to need to be quantified in one of those 3 places. So all the risk inherent in the business needs to somehow be covered but not overlap in any of those 3 inputs. And the value drivers that we identify through that financial analysis are going to allow us to determine whether or not we're properly accounting for them in each of those 3 in any of those 3 places. So again, when we talk about value drivers that we've identified through the financial analysis, they're going to be very company specific. What is it that drives the value? What are the items that have the biggest impact on value? And so in trying to tie it back to those 3 different places, as an example, if we think a value driver is the company's relationships with its customers, where are we capturing the benefit of that value driver? It's going to be in the numerator, the cash flow, the fact that the customer comes and pays money for your goods or services. If we think that the value driver in a business is they have key know-how, so maybe it's an engineering firm and they can engineer, they can do much better than the competition at solving problems. Where do we recognize the benefit in that equation of that value driver? It's going to be in the denominator. Against an otherwise equal engineering firm, they're less risky because they have this key know-how, this value driver. Maybe it's a recurring revenue stream. So you have a business that already knows that every year, it's a subscription-based business. Every year, my base revenue starts somewhere above 0. Other things being equal compared to a business that doesn't have that recurring revenue, you're going to be able to see that it is more easily able to achieve that expected future growth because it's starting at a point already higher than the competition. So a quick example, technology business develops a product and we've identified that product as the primary value driver. That product has seen significant growth over the past 3 years, 18% growth year over year. So once this is identified, you need to, as the valuator, as a hypothetical investor, you need to identify, or you need to try and understand what risk and benefit is associated with this specific product. So you're going to take a look at, can those sales continue at that rate? Do you think that 18% will continue in the future? It may be something less than that. Is competition going to come in and try to knock off that product to make it so that you're not going to be able to achieve the same level of revenue that you had before? So what is the benefit? What is the risk associated with it? And will that change into the future? Are really the questions that you need to ask. So if you believe that there is risk in any of those 3 things, if you believe that there is a risk that the revenue is going to decrease in the future, we change the numerator in our equation, right? We're going to decrease what we believe is the true cash flow that we're going to receive from this product. If we don't necessarily think that the revenue itself is going to decrease, but there is risk that it could decrease, we're going to increase that denominator, the risk associated with that specific product, or that we're going to increase our rate of return that we require for investing in this company because of this specific product. Both of those things, again, are simplified equation. If you decrease the numerator, if you increase the denominator, are going to decrease your overall value because you've identified with this very specific value driver that there is associated risk with it looking the same going forward after you buy it. So switching over to the market approach. So our second approach to value, again, at a simplified version, what we're going to be looking at is 2 things. It is that same, what is the expected future benefit whenever you buy a business, measured very similar. It's going to be EBITDA. It's going to be some type of historical earnings that we may adjust to say, what do we think that that's going to look like going forward? And then what is some type of market-based multiple that we are going to apply to that EBITDA? And the way that we measure that, we have two different methods that we're able to measure it. It's either completed transactions of other companies. We can go look to see what other companies sold for, and we look at their earnings and say, all right, well, here's the indicated multiple based off of this transaction. So it's either private transactions or a public company being taken off the market, but transactions of controlling interest in the business, or a guideline public company method. You look at sales of primarily minority shares of businesses traded on the public markets, and you say, what is that indication of value based on the PE ratios? Take that multiple and apply it to my subject company earnings. So that financial analysis that we've talked about is going to be used on our subject company to determine what necessary adjustments we need to make to EBITDA. So anybody that is, like Melissa talked about before, anybody's gone through a quality of earnings report or looked at a SIM before, you're going to see a section that talks about adjustments to EBITDA, normalized EBITDA. That's the same process that we're going to undertake in doing the market approach. We need to scrub out any one-time occurrences. We need to make sure that that EBITDA is what we'd expect going forward. We're not going to expect PPP going forward. We're not going to expect ERC going forward. Then we're going to apply that market-based multiple to our earnings to provide us an indication of value. If we believe that our subject company is riskier than those transactions that we've taken a look at, the companies that have been sold or that public company, then we can adjust that multiple. So we've already kind of normalized the earnings stream, and now from the risk perspective, we compare how risky do we believe our company is compared to how risky is this multiple embedded in these companies that we've taken a look at. So similar to the income approach in terms of how we quantify the earnings, it's just we're quantifying risk a different way. We're allowing the market to tell us what they believe the risk is going to be. And then finally, the last approach, the cost asset approach, pretty simplified approach again. Equity is going to be the value of your assets minus your liability. So it's strictly looking at the balance sheet. So that financial analysis is going to allow us to determine whether or not the items, the line items on the balance sheet are listed at market. So an easy one that we always bring up is, all right, are our receivables 100% collectible? I have $2 million of receivables, $500,000 of those have been on there for 10 years. Probably not collectible. Whenever we go and do our market or our cost asset calculations, we're going to say we're adjusting those receivables from carrying value to whatever we believe that market value is based off of this analysis. But you also have to record any unrecorded assets or liabilities. So from an asset standpoint, as Melissa said, intangible assets aren't going to be recorded on the balance sheet. So we need to quantify and record those intangible assets that a business has. From a liability perspective, if they have a lawsuit and environmental liability, that needs to be quantified and recorded if it's not already recorded based on the fact that we're likely looking at GAAP basis statements. When we're able to record all of those assets and liabilities and mark everything to market value, that market value assets minus the market value of the liabilities should give us the market value of the equity of the business. So kind of wrapping up this section, this process, to summarize, this process of the financial and ratio analysis really is going to help us identify the strengths and weaknesses of the company, or as we like to call it, the risks associated with the company, and how risky or how strong is that business compared to other comparable investments. And those results should be compared to historical, that trend analysis. It should be compared to other comparable investments, so usually companies within the industry, to give us some semblance of how more or less risky this investment may be. Discrepancies between our company and competitors, that benchmarking needs to be understood and again, properly included in our calculations. Is it going to impact that discount rate? Should it hit the cash flow directly? How do we mechanically include it in the calculations? And then failure to align with that industry data can be cause for greater concern. So increasing our risk. Again, increasing risk, increasing that denominator is going to decrease value on the whole.
Thanks, Pete. To wrap things up, we all understand that the financial statements are really an accumulation of actual transactions. They're also going to have estimates. They're going to have judgments, certainly on the part of management as you have forward-looking financials. those numbers that are sitting on the financials really mean anything without additional analytics that are done. And obviously, as you can see here, the analysis that we do is certainly going to be the foundation or the basis for valuation calculation as well as application of any discounts. Thank you so much for your attention. You guys have break now, and then we'll be back in 10, I believe. Thank you, guys.
Thank you.